What if I told you that a guy trading from his parents' bedroom once caused $1 trillion market crash? Or that a major bank accidentally wired $900 million to the wrong people and couldn't get it back? Or that women are consistently better traders than men, but nobody talks about it? You'd probably think I'm making this up, right? But every single one of these statements is 100% true. Documented, verified, published in academic journals and court records. The world of trading is way stranger than any conspiracy theory you've ever heard. I'm going to show you 10 mind-blowing truths about trading that will completely change how you see financial markets. These aren't opinions. These aren't trading tips. These are verified facts that reveal what trading really is. And trust me, the truth is way more interesting than fiction. Let's dive in. August 1st, 2012. Knight Capital Group, one of the biggest trading firms on Wall Street, is about to have the worst 45 minutes in financial history. They're rolling out new software, standard procedure. 7 of their 8 servers get updated with the new code. But one engineer forgets to update the 8th server. That 8th server is still running old code. And buried in that old code is something called PowerPeg, a function that was supposed to be deleted years ago. When the system boots up, that forgotten server thinks it's getting a command to activate PowerPeg. It starts buying stocks at the ask price, over and over, without limit, without stopping. In 45 minutes, Knight Capital racks up a position worth $7 billion. By the time someone notices and pulls the plug, the damage is done. They're forced to liquidate everything. Final loss, $440 million. The company goes bankrupt. 45 minutes. One forgotten server. That's how fragile the system really is. May 6th, 2010, 2:45 p.m. The Dow Jones suddenly drops 1,000 points in minutes. 1,000 points! That's $1 trillion in market value, just gone, vanished. Traders are panicking. News anchors are scrambling. The FBI launches an investigation. They're looking for a sophisticated hedge fund, a rogue algorithm, maybe even a foreign government. The trail leads to a semi-detached house in Hounslow, London. Inside, they find Navinder Singh Sarao, mid-30s, lives with his parents, trades in his pajamas. This guy, single-handedly, had just manipulated the most sophisticated financial market on Earth. Not with billions in capital, not with a team of programmers, just him, and a clever trick. His strategy was called spoofing. He'd place massive fake sell orders, thousands of contracts, far away from market price. The algorithms see this huge selling pressure and panic. They start selling too. Right before his fake orders get filled, Sarao cancels them. Then he buys at the crashed price. He did this for years, made $40 million from his bedroom. The market is more fragile than anyone wants to admit. Sometimes you don't need sophisticated manipulation. Sometimes pure human stupidity is enough to cause chaos. Samsung Securities, 2018. An employee is supposed to issue dividends, 1,000 Korean won per share. Instead, he types 1,000 shares per share. The system spits out 2.8 billion phantom shares, over $100 billion worth. Some employees sell them before anyone notices. The stock crashes 11%. Or how about this one? Citibank, 2020. They're supposed to pay $7.8 million in interest for a Revlon loan. Someone clicks the wrong box in their software. $900 million gets wired out, the full loan amount, from Citibank's own money. They ask for it back. Some lenders refuse. It goes to court. The judge initially rules, finders keepers, $900 million, gone, because of a checkbox. And crypto isn't safe either. 2017, GDAX exchange. Someone places a massive market sell order on Ethereum. The price is $317. It crashes to 10 cents. Not $10, 10 cents. Why? Because the order was so big it wiped out every buy order in the book. Then it triggered everyone's stop losses. Chain reaction. Boom. People got liquidated. Fortunes evaporated. All because one person hit the wrong button. All right, here's a fact that's going to make some people uncomfortable. Women are better traders than men. This isn't opinion. This is data from Fidelity, Wells Fargo, and Warwick Business School. Multiple studies, thousands of accounts analyzed. Women's portfolios outperform men's by 0.4 to 1.8% every year. That doesn't sound like much, right? But compound that over 20 or 30 years, it's a massive difference. So what's the secret? Are women better at reading charts? Better at analysis? Nope, they just trade less. Men trade 45% more often than women. And here's the kicker. All that extra trading doesn't help. It hurts. Every trade costs money in fees and spreads. More importantly, every trade is another chance to make a mistake. Women are more patient. They stick to their plans. They don't feel the need to constantly do something. Why do men trade so much? 2 words: overconfidence and ego. Trading activates the competitive part of the male brain. It becomes a game to beat the market. Testosterone levels rise during winning trades, which makes them take even bigger risks. Women approach investing as a tool for long-term security. Men approach it as a competition. And the market doesn't care about your ego. It rewards patience and punishes action. So yeah, less action, better results. Who knew? Does being smart help you trade better? Researchers in Finland actually studied this. They took IQ test scores from military records and matched them with trading accounts. And yes, high IQ traders do perform better. But not for the reason you'd think. High IQ traders don't have better predictions. They don't pick winners more accurately. What they do is avoid stupid mistakes. They don't panic sell when prices drop. They use limit orders instead of market orders, saving money on the spread. They do tax loss harvesting, selling losers at year-end to offset gains. They time the market slightly better during high volatility. Small edges, but they compound. But here's the twist. Intelligence can also backfire. Smart people tend to overcomplicate things. They build elaborate systems when a simple strategy would work better. They think they can outsmart the market. That's still ego, just intellectual ego instead of emotional. The market doesn't care how smart you are. It cares how disciplined you are. Picture this. It's 1988. The Wall Street Journal wants to settle a debate. Can professional stock analysts actually pick better stocks than random chance? So they create a contest. On one side, top Wall Street analysts with decades of experience, research teams, insider knowledge. On the other side, a dartboard. Literally. Throw darts at a list of stocks. Whatever they hit, that's the portfolio. They ran this contest 142 times over 14 years. Who do you think won? The results? Over 14 years, the pros won 61 contests. The dartboard won 61 contests. 20 were ties. The professional analysts, with their research, their Bloomberg terminals, their insider connections, barely beat random chance. 43% of the time, a monkey throwing darts would have done just as well. Think about that. These are people whose entire careers depend on picking stocks. This wasn't a fluke. This was proof that stock picking is mostly luck dressed up as skill. This is the efficient market hypothesis in action. All available information is already priced in. The experts aren't bad at their jobs. They're actually really good. But so is everyone else. When everyone has access to the same information, nobody has an edge. So all those predictions you see on CNBC, all those analyst ratings, they're not much better than a monkey throwing darts. 1983. 2 legendary traders, Richard Dennis and William Eckhart, get into an argument. Dennis says traders can be taught. Eckhart says they're born, not made. So they make a bet. Dennis will recruit random people off the street, no experience required, and teach them his system. He places an ad in the newspaper. Out of 1,000 applicants, he picks 21 people. An actor, a security guard, a game designer, total amateurs, no trading experience required. He calls them the Turtles. For 2 weeks, Dennis teaches them a mechanical trading system, strict rules, when to enter, when to exit, how much to risk, no discretion, no gut feelings. Then he gives them real money and sends them off. Over the next 4 years, the Turtles collectively generate $175 million in profits. From scratch, from amateurs, in 4 years. So what's the secret? It wasn't genius. It wasn't intuition. It was discipline. The Turtles followed the rules religiously, even when it felt wrong, even when they were losing, even when their gut told them to do something else. The system had a low win rate, only about 40%, but the winners were massive, and the losers were small. Most people can't handle that psychologically, but if you can, you don't need to be a genius. You just need to follow the process. Okay, this is where it gets weird. Financial markets have these strange patterns that keep showing up even though they shouldn't exist. The January effect. Stocks, especially small caps, tend to surge in January. Why? People sell losers in December for tax reasons, then buy back in January. The Halloween effect. Sell in May and go away. Markets perform better from November to April than from May to October. A 2024 study confirmed this still works in developed markets. It shouldn't, but it does. Now let's talk about W.D. Gann, a trader from the early 1900s. This guy used astrology, planetary positions, sacred geometry. He'd chart the moon cycles and Jupiter transits to predict market movements. And here's the crazy part. He was absurdly accurate. He predicted the 1929 crash, called commodity prices to the penny. Was it the astrology? Or was he just a genius at pattern recognition who happened to frame it in mystical terms? Nobody knows. But his methods are still studied today. And my personal favorite, the inverse Cramer strategy. Jim Cramer hosts a show called Mad Money where he gives stock picks. Problem is, his picks are notoriously wrong. So someone created an ETF, ticker SJIM, that automatically bets against whatever Cramer recommends. It's a joke, but it's also a real investment vehicle. That's how skeptical people are of TV experts. The market has a sense of humor. Sometimes betting against the gurus is the smartest play. So what do all these stories have in common? They're all about human behavior. Knight Capital failed because someone forgot a step. The flash crash happened because one guy exploited herd mentality. Fat fingers happen because humans make mistakes under pressure. Women outperform men because they control their ego. High IQ helps because it improves discipline. Monkeys beat experts because prediction is an illusion. Every single story reveals the same truth. Markets are mirrors. They reflect us. Technology changes. Algorithms get faster. Software gets more complex. But human psychology? That stays the same. We're still driven by fear and greed. We still overtrade when we're confident and panic when we're scared. We still prefer being right over being profitable. The Turtles succeeded not because they had better information, but because they had better discipline. Your edge isn't in prediction, it's in self-awareness. So here's the real truth about trading. It's not about finding the perfect strategy. It's about understanding yourself. Can you follow rules when your gut screams otherwise? Can you cut losses when your ego wants revenge? Can you sit still when your brain demands action? That's what separates the 10% from the 90%. If you want more content like this, real research, real stories, no BS, hit that subscribe button. I'll see you in the next video. Stay disciplined.